So a bond that has a coupon of $50 and a face value of $1,000 has a coupon rate of 5%. This is the interest on the loan. The loan agreement ends when the bond reaches maturity. Maturity is the length of time on the loan and is also the point at which your invested principal is returned to you. Bond maturities range anywhere from 1 to 30 years. Loan investments with maturities less than a year are usually referred to as commercial paper or bills. Bonds with maturities of 1 to 10 years are sometimes referred to as notes. And bonds of 10 to 30 years are simply bonds. Despite having a maturity of 30 years, some bonds can be paid off early. These are known as callable bonds. Callable means that after a certain period of time, the bond issuer may return the invested principal back to the investor, paying off the loan early. The investor will keep all interest paid to that point, but won't expect any more coupon payments after his original principal has been returned. So, let's review. When an investor purchases a bond, he's actually loaning money to an entity, like a company. In return for the loan, the company will pay the investor interest, usually on a semi-annual basis. The interest provides regular and consistent income for the investor until maturity, which may be anywhere from 1 to 30 years, depending on the bond purchased. However, income is subject to the credit risk of the issuer of the bond. If an issuer defaults, no future income payments will be made. At maturity, the investor has his initial investment or principal returned to him. Keep in mind, not all bonds are the same. Some come as secured or unsecured, providing varying degrees of protection. Some issuers have varying credit ratings. Some carry different interest rate structures and offer various repayment schedules. Investors should keep these factors in mind before investing.
Okay, again, another paid political announcement from an investment house, but that's okay. But the key thing about this is that we need to make sure we understand these vehicles, not so much as an investor. This is not an investment class. There's a couple investment classes in the MBA program, especially if you're in the finance concentration area. But this is understanding what investors are looking for when they go into the market, so how companies attract these investors to lend them money in bonds or to issue stock that they will purchase. There's a couple other interesting videos in our playlist, and take a look at them if you can. But one of the key things that when we talk about risk, it's beta. Some of you might have heard about this before, beta. And remember in the first video we looked at tonight, it talked about how you determine or the standard deviation of risk and return. If the greater the standard deviation, the greater the risk. I mean, the likelihood of you failing is greater. That means you have a greater risk. Well, that is transferred to many of us in the calculation of standard deviation and risk aversion in the form of what is called a calculation of beta. For example, United States Treasury issue has a beta of 0. No risk whatsoever. The United States government is going to pay that off no matter what. All right. Whereas if I go tomorrow morning and call up Wells Fargo bond department and say, hey, dudes, I want to buy a government of Greece 10-year bond. They go, really? You want to do that? Yeah, I want to do that because the interest rate on that bond is 17%. Hey, Mr. Hassey, do you realize that that bond could probably go default in the next couple of years? I'm willing to take that risk because the beta of that bond this morning was 5.31. Any beta over 4, you stay away from. But I'm a sucker. I want to get that high coupon payment, that high interest payment, and I'm willing to take that risk. So when it comes to understanding stocks and bonds, it's all about the risk reward of the individual investor, but also the risk and reward of the company issuing the capital that is trying to get the money. So that leads us to a couple of basic theories. And again, some of you, I might be boring. You might already know about this. But at the same time, some of you, it's been a while since you've taken finance or studied this, and this is a nice little refresher. Oops. going to the whiteboard, which I publish after we're done. I don't know about you, but the last couple of days, my technology has been the technology from hell. Nothing's been right. I have here Spectrum cable. Well, the internet connection has just been atrocious the last couple of days. University of Laverne, the infrastructure of operating the cloud and Blackboard has just been up and down like crazy the last couple of days. It's been a pain in the neck. So I'm a little sensitive to technology tonight. So if I inadvertently say a bad word because of something not going right, I apologize in advance. All right. Well, tonight, again, we're talking about risk. We're talking about risk and return. And for us in corporate finance, that means what we can provide investors to cover that risk. All right? To cover that risk. What can we provide investors to cover that risk? All right? For bonds, it's very attractive. The pros of bonds. We're pretty well guaranteed payment. Why? Because if they default on coupon or interest payments or default at maturity, they have to sell off assets and we still get our money. You still get your money. When a company goes broke, who's at the top? There's two things at the top of the list to get paid first. Number one, Uncle Sam and the tax man. And number two, the bondholders. They get paid first, right at the top of the list. So that's how you avert risk with lending your money to a corporation, is because you're in all likelihood going to get your money. Now, yes, if you're lending your money to the government of Greece, that could be a different situation. If you're lending your money to Radio Shack, that's a different situation too. But how are you awarded? If you do lend to a company that has bad credit, you get high interest payments. High interest. In the markets, they call that junk bonds. Junk bonds. High interest, high risk investments. So if you're an investor who is willing to take that risk, get into it. But this is evil for corporations. They don't want high risk. They don't want bad credit. They don't want to pay higher interest. Why? Interest equals fixed cost, which equals leverage. When some companies are highly leveraged, it means they have high interest payments, high fixed costs. And if any of you know anything about running a business, the less fixed cost you have, the better. Because remember back to our business finance intro days or our accounting days, the contribution margin between selling price and variable cost per unit has to cover the fixed cost. The higher the fixed cost, the more units you have to sell to make a profit. So if I have high credit, high interest, high fixed costs, I'm on the slow track to making profits. So companies, it's in their best interest to avoid bad credit. Keep their credit ratings. We have a gentleman, and am I going to slam him here? No, I'm not going to slam him. But we have a gentleman at University of Laverne. His name is Avo Kashishian. Mr. Kashishian is the CFO of University of Laverne. His whole life, and I'm not being obnoxious here. Yeah, I know, because I used to be one of these people. His whole life is to keep our credit rating as low as possible, as best. That's his whole life, to keep Laverne to have a good credit rating. This last quarter, the Laverne credit rating was B+ in the markets, issued by Moody's and Fitch, which are credit rating companies. B+. What does that mean? We're a little bit better than average. Not great, but not bad. Mr. Kashishian, as the chief financial officer of Laverne, he runs the business financially to make sure we maintain at least that B+ rating. If we don't, his fixed cost, his interest payments are going to go up. And Laverne cannot afford that because we are on we have no revenue growth. Our revenues do not grow. And you guys know this. Would you guys keep going to Laverne if we raised our tuition this next semester up 10%? Hell no. Unless you really like Mr. Hassey and want to have him again. I wouldn't take Mr. Hassey if my tuition was going up 10%. You're going to go to another place that's cheaper. You can't afford it. Why? Because you want to be risk averse in your financial planning. If you have to pay a 10% increase in tuition, and if you're borrowing the money, that means you're borrowing more money and going to have more loan payments. Or if you're not going to borrow the money, it's going to come out of your pocket, then that means you don't have other things to spend on for your family. Hell no, I'm not going to pay 10% more. It's the same thing for corporations and the University of Laverne. They have to manage their credit to keep their costs down. If they don't, those costs are going to be passed on to their customers, and then they're getting into trouble. No way, Jose, I'm going to go to Cal State Fullerton. I'm going to go to a community college. If it's graduate study, I'm going to wait. I'm going to take a year off and wait and see what the hell happens. Or I'm going to ask my employer to pick up more of the tab. And that increases your employer's fixed cost. Ha. So it's a revolving circle. The pros to bond investment is you're going to get paid. And the pros for bond investment is the companies know exactly what they have to pay back, when and how. Coupon payments, either twice a year or once a year. Principal payments at maturity. If it's a callable bond, they can call that bond in when they all of a sudden they get a lot of money. They say, oh, we don't want to pay this debt anymore. Let's call in the bond and pay it off. Or it's a convertible bond. They can convert the debt to equity. If Nazreen owns a 10,000 bond at a company, they might say, Nazreen, how'd you like to convert that $10,000 bond into 5,000 shares of stock? You're going to be an owner instead of a creditor. Oh, I might take you up on that. But if Nazreen was smart, she'd do her homework and say, why do I want to be an owner of this place? Give me my money now and I'm out of here. Again, it depends on your own personality in investing. So bonds have a lot of advantage, but for corporations, the key pro is tax break. You get a tax break on borrowing money. You deduct the interest. You can deduct the interest. That's a tax break. So really your true cost of borrowing the money is less because you can deduct part of that interest on your tax return. That's the advantage to debt financing for corporations. It's tax deductible. They can put those cash flow demands of a debt right into their operating budgets. When is interest due? Oh, we got to pay it by July. When's this maturity? Oh, it's in 10 years. We got to start socking money away. Stocks are a whole different ballgame. There's no set schedule. There's no determination of when you have to pay or not. It's all up to the market and what the stockholders demand. And stockholders, I'm going to use an analogy here, and I hope I don't offend anybody. I'm just stating this for my own personal fact. Stockholders are like mother-in-laws. One day they love you. The next day they'll slam the door in your face. All right, I can take that for my own historical reality. One day you're the greatest guy on earth. The next day, get the hell out of here. I can't believe my daughter's married to you. And that's like stockholders. very fickle, very market friendly, and it can be a real pain. That's why over 60% of all capital financing is borrowed money. I don't even want to deal with shareholders if I don't have to. I don't want to issue any more stock than I have to. I have to issue stock because it tells the market world, like banks and creditors, that I'm a viable company and I have ownership that's willing to invest with me. But I could care less about shareholders. A perfect example of that is Steve Jobs, who's no longer with us. But Steve Jobs wouldn't give the time of day to a stockholder. Get the hell out of my face. Now, he could get away with that because the stockholders knew that he walked on water. He was a genius. But during his management of Apple, both times he did run Apple. Remember, once he got fired, what a mistake that was. But then he came back. Both times he ran Apple, he told the stockholders, get away from me. If you want to deal with somebody at Apple, here's our CFO, talk to him, but I don't want anything to do with you. He never paid them dividends. Never. Why? He just wanted their money as capital investment, and that's it. I don't need you at all after that. Get away from me. Now, Steve Jobs could get away with that. As soon as he died, and Tim Cook took over Apple, the first thing, a week after Steve Jobs' funeral, the board of directors representing the shareholders sent an email or a memo to Tim Cook saying, all right, Steve Jobs is dead. We want our dividends now. All right, Steve is gone. Now you can pay us dividends because he can't stop you. And that's exactly what happened. Apple had to start paying dividends. Now, they haven't paid them every quarter, but they have. That's why companies like debt financing. It's manageable. It's only manageable, though, by your credit rating. It's controllable, and you get a tax break. That's the nice thing about it. Stocks, on the other hand, I like to call stocks as a manager, corporate manager, are Darth Vader. You got to watch out. Because stockholders will fire you as soon as you have one bad quarter. Stocks is what have you done? What have you done for me lately? One of those things. Oh yeah, you made a lot of money last year, but what have you done this year? Oh, it's a pandemic? Oh, my stock price is down? Well, guess what? We're not going to give you a raise this year. And by the way, if you have another bad quarter, we're going to fire you. Yeah, but 2 years ago and a year ago, you were making more money than anything. Oh, I don't care about that. What have you done for me lately? Because stock is different from bonds because it's equity, it's ownership. And for many investors, stock is the future. You're betting on, when you buy stock, that the stock will go up. It's an investment in the future. Where bonds is lending your money and getting paid today, there's no growth potential. You're just getting your money and then you're getting it at maturity. Yes, you could sell the bond in the market, but then you're taking a risk if the market rates have gone up or down, and we'll talk a little about that a little bit later. But stock and equity investment is the future. And who knows what the future holds? It's very unexpected. So companies, in order to, if they're going to go to the equity markets and sell stock and issue stock, it's all based on their performance of the past. Well, our stock has gone up 10% on the average over the last 5 years, yearly. Really? Okay, maybe I'll invest in it. You have a track record. That's why for small companies and for companies that are in highly volatile markets, issuing stock is dangerous because their track record doesn't look very good. Now, every now and then you're going to find the solar company that's starting in Santa Ana that's got a great idea for a solar panel, and they're going to take off and make a ton of money. But those are few and far between. Most of the time, stock investments is for the big the big players who have the capital to take that capital and keep returning those demands on that return over many periods of time. Small companies can't provide that. That's why stock investment in small companies is rather limited to what you can earn, unless you catch that solar company in Santa Ana that has a great idea and hits it right at the right time. Or you hit that pizza company that all of a sudden everybody wants their pizza. But it doesn't happen very often.
Professor Hasse, can a
Yes,
company
Preston.
have stocks and bonds?
You sure can.
A company can sell stocks and bonds?
They sure can. They have to, especially if they have a lot of high demand for capital. They find that, and we'll talk about this next week, you find what is called the optimal capital structure. That mix of debt and equity that provides the greatest value for your return.
So when the company goes under, does the company have to pay back the the stockholders first, or the bondholders?
The bondholders get paid first, and the stockholders get paid last.
Even though the stockholders own part of the company?
They get paid last.
Huh.
Because why? If you owned your house and you weren't making payments, or if you owned something, you weren't making payments, that's your responsibility. You're the owner. You can't get any return until you meet all the obligations of that house. In other words, if you're the owner, you can't make any money until you satisfy the obligations that you owe, right? That's the reason why stockholders at the boy, I can tell you that from from personal experience. 2009, Mr. Hasse owned 10,000 shares of General Motors stock. Woke up one morning with a phone call. Hello? Hey, Mr. Hasse, this is your stockbroker. Hey, how you doing? What's up today? Well, I got some bad news for you. General Motors just declared bankruptcy. Your stock is worthless. Oh, thanks. Have a nice day. I lost 10,000 shares of stock in one day. Now, it's been going down for a while, but I thought General Motors can't go bankrupt. First of all, Obama's going to bail them out. Not. I'm not going to tell you how much I lost, but I lost 10,000 shares of stock. Why? As Preston just asked, it went bankrupt. Stockholders, their stock is now useless. I couldn't go the next day to my brokerage and say, all right, give me what you can for General Motors. No, here's why. General Motors has to pay back their bondholders first. General Motors has to pay the IRS first. General Motors has to pay their pension plans for their employees next. General Motors has to pay their vendors next. Guess what? There's going to be no money left over. You're out. That's where the risk is in stock investment. In bond investment, you're guaranteed to get paid because you're at the top of the list. Stock, nope. Now, this is a true story. You guys are going to laugh, but it's true. I have a man cave in my house. Man cave, if anyone knows what that means. No women allowed. All right? It's okay. I got to have my little area. Football, cigars, poker table. If anyone knows this game, foosball table. And there's always beer taps on tap, ready to fire up. It's a man cave. Katrina, Nazarene, you can relate to that. I want my space. In this man cave, I have a bathroom because my wife refuses to have my friends smelling of beer and cigars to come up to our first floor and use the bathroom. So I had to put a man cave bathroom in my basement. Guess what? When I put the man cave basement together, I had 10,000 shares of General Motors stock that was worthless. Guess what I wallpapered the wall with in my man cave bathroom? My General Motors stock certificates. That's how worthless they were because they're on my man cave bathroom wall. So if any of you, only the men, if you ever come over to Claremont, come over to my house, Nazreen, Katrina, can't invite you in, sorry. But the boys, if they want to come over, we'll go downstairs, talk about finance, maybe have a nice diet beverage, smoke a cigar, play a little game of pool, maybe a little Texas Hold'em, and you'll go into the bathroom and then you'll say, oh, Mr. Hassey was right. There's all those shares of General Motors stock on the wall right there. He was right. They're worthless. They're sitting on his bathroom wall.
Uh, Mr. Professor Hassey, aren't they only worthless while General Motors is down? Once they go back up, aren't they still?
No, because when General Motors declared bankruptcy, then they came out of bankruptcy issuing more equity and more stock. But my stock was gone. So the first thing my broker did about 6 months later is call me up and says, hey, Rick, you want to buy more shares of General Motors? They just went into the market to issue more stock. Get the hell out of here. So Preston, my stock once declared bankruptcy is Zippo. And then if I wanted to, then when General Motors came out of bankruptcy, as a matter of fact, since they've come out of bankruptcy, they've done very well. They issued a whole new line of IPO stock. I cannot go back in and sell my stock in the market now. They'll take a look at those certificates and go, hey, I thought this was on your bathroom wall. What are you trying to sell it for? These things are worthless. And they're right. They're worthless still. That's the danger of stock. You got to watch it. Yes, you see that Elon Musk and Warren Buffett and Bill Gates and Steve Ballmer of the Clippers and all these dudes make all this great big money investing in the stock market. For one of them, there's about 100,000 of us that don't do very well, right? It's very, very speculative. Now you can be conservative, and that's what Preston was. What you do is you invest. Maybe you have a portfolio, you invest 70% in stocks and 30% in bonds, or 40% in bonds and 60% in stocks. That's what's called diversification. And you balance that out. So if something happens to your stocks, you still have the reliability of getting some interest income and sure things by holding some of those fixed income bonds. Corporations are the exact same thing. They want a combination of bonds and stocks because why? Bonds are cheap, low interest, tax deductible, but at the same time, they want to show the world that their company is sexy, for lack of a better term. Invest in us, buy stock in us, and you make a lot of money. It's sexy to own stock. Investing in a bond is kind of boring. When I was a kid, my grandfather always used to tell me, Rick, when you grow older, buy bonds. Well, by the time I got ready to go investing in bonds, I go, this is boring. I'm buying stock. After a while, I figured it out. I need a combination of both because on some of those stock picks, like General Motors, I lost. So you want to have a combination, and that's why corporations want a combination of that matching of debt and equity. And it's all based on risk aversion. With debt financing, credit financing, for the investor, it's fairly risk-free. And it's low cost to the corporation that's issuing it. Okay, that's fine. But at the same time, you want to attract the big money investors who want to buy stock because they're drooling over the fact that you could make a lot of money. But companies have to know that stock is the most expensive form of financing. Why? To issue stock, you got to hire an investment banker to represent you in the market. That's an SEC requirement by law. That's expensive. That's why small companies can't issue stock. It's too expensive for them. They can only borrow money from the bank. Everything else, it's too expensive. Or go on Shark Tank. And then you give up your company. And in stocks, though, it's expensive because you have to meet the demand of the future. Why do investors invest in stock? Because they want to make at least 10% a year. They want to get a dividend every quarter. Whew, that's expensive for companies. So you got to be pretty sure of yourself and investing in investments or assets that are going to generate these kind of returns, because again, you have one bad quarter and you're out. Jamie Dimon runs JP Morgan Chase, the largest bank in the world. His annual salary, hang on to your seatbelts on this one, Jamie Dimon makes $65 million a year in salary. First of all, what do you do? Can you imagine the tax he has to pay on that sucker? Imagine getting his paycheck. Oh, here's It's 65 million. So that's roughly $5 million a month. He gets a paycheck, $5 million. Can you imagine how much tax he has to pay? But here's the kicker. Every December, he gets a bonus. Last year, Jamie Dimon got a $200 million bonus in December. So last year, 2019, Jamie Dimon made $265 million. Boy, that's a rough year. And here's why he makes that money. Because his investors, his stockholders, his fellow people who lend Chase money, who do business with him, he makes money for them. He makes 20% returns. He produces solid balance sheets, lots of profits, the largest market capitalization of any banker and financial institution in the world. He provides the return, so they're going to pay him $265 million because they get that money back and then some. In their eyes, he's cheap. Meanwhile, you and I, who make $50,000 a year, are hanging on by our fingernails, keeping our job. That's why you're in MBA school, so you can get the marketability, the experience, not only academically, but professionally. And then you can say, no, dudes, I'm going to create value for you. Give me 200 grand a year because I'm going to make that money for you. That's why you go to graduate school. That's why you build your career. But that's what Jamie Dimon does, because he provides return to the market. So he gets $265 million friggin' dollars a year. Unbelievable. But 4 years ago, he almost got fired. He almost got fired because he had one bad year. JP Morgan Chase lost market share to Citibank, to Citicorp. JP Morgan didn't make their expected profits that they thought they would. They almost canned him. He came very close to being fired. So that's how fickle it is in the markets. And that's why companies want to find that balancing act of financing debt and equity. All right, when we come back from our break, I'm going to show you a little spreadsheet that kind of gives the details behind what we've just been talking about stocks and bonds. The reason why we invest as a corporation and borrow money and issue stock is to create future value for those investments to the shareholders. How do we create future value for those investors? We take their money, invest in assets that are going to create future value for us. We invest in equipment. We invest in buildings, land, markets, product development, R&D. We invest in Walt and hire him to produce those returns over time. That's what we do with the money. If we don't do that, we're in big trouble, because we have to give those returns out to those people. So present and future value is a big concept for this, because we have to understand that concept of what's the present value of money today and what are we trying to get to the future value in the future. And that leads us into other discussions, and we'll talk about that after our break. So let's take a 10-minute break, 11-minute break, and come back at 7:15 p.m. Let's come back at 7:15. So smoke them if you got them. Go see if the Dodgers are losing. The Yankees are getting whipped. And then we'll come back at 7:15. And I'm going down to the man cave and just stare at my General Motors stock certificates and cry a little tear. All right, everybody, I'll see you back at 7:15. Adios.